Over the next 30 minutes, I'd briefly like to show you the structure of the tool by sharing my screen, and then I will take you through the key steps that you need to follow for entering the data specific to your business. So it starts with the cover page. Here you have an overview of the sections. So these are the sheets that are part of the main model, which are the ones that we will focus on today. It starts with a dashboard, then you have 2 assumption sheets, calculation sheets, and then 2 output sheets, one in local currency and one in US dollar. Then this is an explanation of the model key, which is the formats that are used throughout the model. Any cells highlighted in yellow with a border are input cells. So these are really the cells where you need to provide the input specific to your business. Then you have any black numbers that are formulas, any brown numbers which are actual figures, and then blue numbers are links to other worksheets. And here you have a list of definitions that are used throughout the model. I'm not going to go through these in detail now, but you can always refer back to this sheet. And then everything I'm going to mention now is also included in the user guide that will be published together with the model, so you can also look it up there. And finally, the numbers that you'll see now, they are dummy numbers. So we only included some numbers to make the visualization of the tool easier. But the idea really is that you'd get an empty tool where you need to compile all the input cells to then get to the projections of your specific business. Then here you have the dashboard. This is an overview of the key metrics and the financial status of a company, which are relevant to investors in the sectors. For example, as you can see, you have the new installations and the total installations, the evolution of the revenues, the evolution of the net income and the EBITDA, then the cash need to finance the growth of the business, the evolution of the debt versus receivables, and then some of the key break-even numbers. Then you have 2 assumption sheets. The main assumption sheets is really where you have to put most of the assumptions. It starts with the company name and model start date, goes on to the currency, then you have to input the values related to the scale of the business, payment plans of the different products that you're offering, etc. I won't go through those in detail now, but I'll take you through that when I'll show you the steps to complete the model. And then for some specific inputs, you have the model assumptions scenario sheet. So the second sheet, this really allows you to provide values for several scenarios of some specific inputs, such as the sales growth, the collection rate, the churn rate, the overhead costs, and CapEx. And then, because I have mentioned it before, so with collection rate, we refer to the ratio of the collected receivable payments over the total receivable payments due for a certain period. And with churn rate, we refer to the ratio of written off and repossessed units over the total units outstanding. Then you have the flex sheets. So this sheet runs some calculations in the background, which are then fed into the detailed model. And these calculations are mainly on the model timeline, the model currency, and the seasonality flag. So this is needed to for example, enable a flexible model timeline. And the next one is the financing sheet. So this is really a month-on-month model of the detailed financing scheme, the equity, the grant, and the debt that you're planning to raise. And once you provide the inputs here, it also flows into the detailed model sheet where you have the month-on-month projections. And I'll show you that now. So this is the detailed model is basically the sheet where most of the calculations take place. It's really a month-on-month model of the new sales, the overall scale of the business, the P&L statement, the indirect cash flow statement, the direct cash flow statement, the cash view of the balance sheet, the accrual view of the balance sheet, and then also the key performance indicators of the companies. This is something that we include because I think it's very useful to see how your KPIs move in line with your with the financial evolution of the business, and it also gives those numbers credibility, and they update automatically as you update the inputs for your company, and so you don't have to calculate them continuously if you change some of the inputs basically. And then what you can see here as well, we included 2 cash flow statements, the indirect cash flow statement and the direct cash flow statement. So the main difference here is that the indirect method takes the net income generated in a period and then adds or subtracts any changes in the asset and liability accounts to get to the implied cash flow. And then the direct method instead really lists all cash receipts and payments made during the accounting period. So the main difference is that it provides more detail about the operating cash flow accounts. And then, as you can see, we have included a cash view and an accrual view of the balance sheet. And the same applies to the P&L actually. As you can see here, we have the revenue in accrual basis and the revenues in cash basis. And here the main difference really lies in the recognition of the revenues and also of the cost of goods sold. So for example, with accrual accounting, you account for the full sale at the time that a customer signs a contract and you expense the full product cost on the P&L as well. And then with the cash view, the revenue only accounts for the cash that you will collect in a given period, and the cost of goods sold reflects the depreciation related to the products deployed in a given period. And we really think it's relevant to have both views included. I'm going to show you an example later of what impact this has, also, for example, when it comes to taxes. Then this is the macro model, which is the main output sheet. It basically summarizes the monthly values into yearly values. And this is what investors will mainly want to look at as they try to understand the evolution of the key financial statements and KPIs. And then of this one, you have a local currency version and a hard currency version, a US dollar version, which basically translates the values in the local currency model into US dollars using the exchange rate in that given, the projected exchange rate in that given year. Then I won't go into those, but you have some additional analysis sheet, such as unit economics, the valuation, and the sensitivity analysis, but these will be covered in the second webinar of this series, so I won't go into those today. And then finally, you have the error check sheet, and this is basically a sheet that conducts automatic error checks and makes sure that no numbers fall outside of the range where they're supposed to be. A very typical error check is, for example, whether the assets are equal to the liabilities and equity on the balance sheet, but I will also show you an example of that shortly. Now, next, I would like to show you how to use the tool and adapt it to your specific business. So the first step is really to fill in all these input fields on the main assumption sheet. So you start with the company name, you indicate when you want the model to start, then you indicate what the exchange rate is of the local currency versus US dollar. And then this I will go into it later because it's a bit more complicated, but it's basically the interest rate differential that will give you an indication of how the currency will evolve. Then here you have to input the scale of the business at the start of the model. So how many installed units do you have actually as you start in the moment when you start projecting? Then here you have to indicate the payment plans for the different products. And I just want to give you an example. So I'll take out the values here for product 5, how you do that. And basically what you do is to first indicate what the down payment is. So say the down payment is 200 in local currency, then what the contractual payment period is. So in this case, let's say the customer has to make monthly installments over a period of 24 months. So we indicate 24 here. And then you have to indicate what the contractual monthly payment per unit is. So how much does the customer actually have to pay in each of those months? And here, let's also say it's 100 in local currency. And then what you can see here is that the model automatically calculates the revenue per unit, plus the VAT, the revenue per unit net of VAT, and then the average revenue per unit per month, excluding a down payment, and the average revenue per unit per month, including the down payment. And this is what flows into the detailed model then. And we'll also have an option to include more than 5 products. So basically here you can input up to 5 products, but what you can do when you have, for example, 5 product categories, but more than 1 product in a category, we have provided an additional product sheet that comes together with the tool that actually helps you to calculate the weighted average across products of one category. And so you can input those as inputs here. And in this way, you can basically incorporate more than 5 products. Then you have to input the cost of goods sold. So first of all, you have to input whether you buy your products in US dollar or in local currency. And this is basically a switch here. And then you indicate what the price is that you pay in local currency, or if it's US dollars here, you indicate it in US dollars, and then it calculates it automatically in local currency. Then you indicate what the shipping costs are, the import duties are, the clearance and handling costs are, local transport costs, and it calculates the cost per unit, including the VAT. You get to the landed cost per unit. Then here you have to indicate the direct cost of sales. So this is basically the costs that increase in line with the units sold. And the main ones we've included are the agent commissions, is the agent commission per new unit sale, then the agent OPEX per new unit sale, such as airtime and transport, then any installation costs that you might have per new sale. This combined gets you to the cost per new sale. Then you might also have costs per repossession. So we also added that. You can indicate a cost per repossession, and you can also indicate a monthly maintenance cost per active installations. Then in some cases, you might also pay your agents a fixed salary. So there is a field where you can include that as well if needed. And then finally, there's a few more costs that move more or less in line with the revenues, which are the mobile money fees, the bank charges, and the call center costs. So you can also include all those here. Then the next section. So these were basically inputs where you could provide on a product level. And then the next section, you provide the inputs on a yearly basis. Most of them across products. Some of them you can provide it on a product level, such as, for example, the sales month-on-month growth rate. But what you can see here is that these are black numbers. So these are not input fields. And these are the values where you actually provide the inputs on the model assumptions scenario sheet. So as you can see, for example, for the sales month-on-month growth rate, you can indicate values for up to 3 scenarios. So the worst case, the base case, and the best case. And say, I mean, here we already have a number in, but we say that our overall month-on-month growth rate is 2%. Now, if I think that in the base case, this is the same across the years and across the different products, I indicate 0 deviation from the month-on-month growth rate, 0%. So here you can see it's 2% for each year and each product. And however, if I say in the worst case, I'm saying, okay, now my month-on-month growth rate is not 2%, but it's actually 30% less than that. So we indicate a deviation here, and you can do that on a yearly and on a product level. And then it automatically calculates the growth rate per product and per year. In this case, we have indicated the same deviation. So you will have 1.4% for each product each year. Then same for collection rate, you can indicate it here. And then for the different scenarios, you can indicate the deviation from that. And then you can indicate the churn rate for the different scenarios. And then finally, you can also indicate the overhead costs and CapEx. Here, I wanted to highlight that this is basically a high level. This provides for a high level estimation of the overhead costs and CapEx, but we encourage the companies to also have a more detailed OpEx model. So for example, in this case, you can see that when it comes to marketing costs per month, we estimated them as a percentage of sales. However, in reality, you might want to have a more detailed calculations of that. So when it comes to the salaries, you might want to look at, okay, how many FTEs do you have in the different positions to serve a certain customer base, and how much do you pay those? And then based on that, you would have a more detailed OpEx model. In the guide, we actually include a link to the EY financial modeling guide for startups, and that also includes an example of that, of how you would model OpEx in more detail. And then, then once you have indicated the different values here, you go back, and then in the yellow cells here, you can choose which scenario you want the model to calculate with. So, for example, I can choose the worst case, but let's for now keep the base case. And what you can also see in the macro model then is here what scenario the model is working with, basically. So you always know, okay, now when I'm looking at the macro model, this is the base case for the growth rate, for the collection rate, for the churn rate, and for the OpEx. Then here you can indicate the tax rates. You can also indicate whether you have to pay your taxes on a cash basis or an accrual basis. I will make an example of that shortly. Then here you can indicate what your balance sheet looks like when you start making the projections. So it's basically the beginning of the balance sheet at the beginning of the model. Then here you can provide some inputs around the funding scheme, so around the debt, the equity, and the grants that you are planning to raise. For that, you can indicate whether you raise that in foreign currency or in local currency. I'll show you an example of the impact that might have on your business. And then finally, you can indicate some of the impact KPIs, such as, for example, the CO2 saved per installation and the livelihoods improved per system. And then finally, you also have the seasonality effect. So that basically it adjusts the projected new sales per month based on the growth rate that you indicated by a seasonality effect. And sometimes, for example, if every year in a given month you have lower sales because it's crop planting season, then it makes sense to indicate that here. So yeah, these are pretty much the steps that you need to follow when modeling, when modeling the projections for your business. And then now I would like to take you through some specific examples. So the first one is the currency effects. I already touched a little bit on that, but I want to show you an example of that. So as I mentioned before, obviously it's very difficult to predict how a currency will evolve, but the interest rate differential can be an indication of that. And so basically saying that if the interest rate on local currency is higher than on US dollar, then you would expect a depreciation of the local currency. And if you don't expect any currency depreciation, then you should indicate 0 here. And why did we include this? The main reason we included this is because a lot of the PAYGO solar companies, they take on foreign currency debt, but then their receivables are actually in local currency. Hence, if the local currency depreciates in local terms, they actually have to pay back a higher amount than in hard currency. And the same is with the cost of goods sold. So if a company buys products in foreign currency, but then actually the revenues are in local currency, if there's a depreciation, then the margin, if you don't adjust the pricing, then the margin worsens significantly, because obviously your products are getting relatively more expensive. And I want to show you an example of that. So if you look at now we indicate an interest rate differential of 0%. So this basically means that we're not expecting any depreciation. And now if we look at the profit margin, it goes from -9% to +12% in January 29. Now say we expect a 5% depreciation, and we go back to the profit margin, and now you actually see that it worsens from -10% to, it gets better until 24, but then it worsens again to -9% actually. And this is because while your payment plans haven't changed, your products in local currency terms have actually become more expensive. And it's similar actually with the debt that you're taking on. So say, again, we don't assume any depreciation in the currency. And then you can see in the cash flow that we are paying back, we have to pay back 1.25 million in local currency in both 21 and 22, then 2.8 and then 5.6 million. And now if we change the interest rate differential to 5% here, what happens is that you see that actually in local currency, what you have to pay back is more than that. So previously it was 1.25 for 21 and 22, and now it's 1.3 for 21 and 1.4 for 22. So you can see that you actually have to pay back, more in local currency terms, and this can have a substantial impact on the liquidity of a company, and that's why we think it's important to also be aware of the effect that the currency depreciation can have on the business. And just to give you a specific example, in Nigeria, the naira depreciated by about 5% over the last year. Then another example that I wanted to show is how to keep track of covenants. So I already mentioned briefly earlier that we always like to include KPIs in the financial models. Actually, let me put it back to 0 for now. And the reason for that is because, one, it shows you how these evolve as your business evolves and in line with the projections, in the financial projections of your business. You don't have to update them manually continuously as you change the inputs. And then for the covenants, it's also really useful because it shows you, just briefly before I show you the example, actually, for those who are not familiar with it, so covenants are basically any rules that a lender gives to the debtor and that the debtor needs to adhere to. So what we did here, we included some of the most commonly used covenants, such as, for example, the debt to equity ratio. But here we really encourage you to look at the covenants that are attached to your deadlines, adjust the formulas accordingly, and then indicate what the requirement, the minimum or the maximum requirement for those is. And how we did it here, as you can see, is we modeled it in a way that whenever a covenant falls out of the range where it's supposed to be, you can see the number highlighted in red. And this shows you basically that you need to take corrective actions early on. So say, for example, we are now, this starts in 2020, so we are in 2019, we've modeled the projections, and we look at the Tier 1 leverage ratio and the total debt to equity ratio, and we see here that it's actually below the required minimum, and the total debt to equity ratio actually in some months exceeds the required maximum. And then what we can do is we go back to our assumptions around financing, and we can see that we had planned to raise debt in January 2020 and equity in July 2020. So now I just want to change that and see what happens. So if we raise equity also in January 2020, and we go back, and as you can see now, the covenants are actually fine again. So you're not risking any breach. So this is very helpful, and it also gives confidence to the lenders that you actually know how your business will evolve. Also, when it comes to the covenants over the duration of the debt. Then another example that I wanted to show is the master error check. So basically what this sheet does, as I explained before, it really contains error checks on some of the most common errors, such as the assets not being equal to the liabilities and equity, or the cash at the end of month, at the end of the period not being positive, or the yearly EBITDA in the macro model not adding up to the monthly EBITDA for the same period in the detailed model. And now what this does is, whenever all checks are okay, you can see the message here in this cell that all checks are okay. And now let's see what happens when some of the checks are not okay. So for example, we go back to the detailed model, we go to the balance sheet, and let's assume for some reason there is a hard code in there. By mistake, I included this number. Now I'm on a different sheet, but I can see here immediately that there are 120 errors in the model. And now it would take a lot of time to find out where this error is. But because I have this master error check sheet, I can go to the master error check sheet and I can see, okay, so there's this 120 errors, and this is because on the balance sheet, the cash view of it, the assets are not equal to the liabilities and equity. So I go back and I see immediately that something's wrong here. So now I can just revert it. And as you can see now, again, it tells me in this cell that our checks are okay. And the cell is on every single sheet. So no matter where you are, you can always see whether there's any errors that you should look into. Then another example that I wanted to show, I briefly mentioned it also earlier, is the seasonality effects. So as I mentioned, this is helpful if in a given year, or if in every year there's like some month where your sales are lower because, for example, the crop planting season, or they might be higher because of the harvesting season, or they're lower in some countries because of upcoming Christmas Eve. And this is something that you can take into account by indicating a seasonality effect. So let's say, for example, in December, we are expecting lower sales. So say 80% of the normal value we would project. And then in September, actually, we are expecting higher sales. So we say 120% of the normal value. And then what this does is basically, if you go into the detailed model, and you go to the projection of the new sales, you have first the theoretical projection of the new sales. So how much would you sell given the monthly growth rates that you indicated? And then these values are adjusted for the seasonality effect here. And then what you can see is the numbers are pretty much the same up to August. And then in September, we indicated a positive seasonality effect. Hence, instead of 12 units of product 1, you will sell 14 units of product 1. And in December, we indicated a negative seasonality effect. So instead of selling 13 units, you actually sell 10 units of product 1. And then the last example that I wanted to show you is the impact of accrual versus cash accounting. And here it's important to note that in some countries, you don't have the choice to choose between accrual or cash accounting, and hence you have to pay the taxes on an accrual basis. But in some countries, you actually do have a choice, or you might be able to impact that. So let's take the VAT as an example. Say now we pay the VAT on a cash basis. So this means that you pay the VAT on the revenues that you actually collect in a given month. Now, if we go to the macro model and look at the VAT that we're paying in the year 2020, it's 400,000. Here you can see, as we've selected, it is paid on a cash basis of the revenues. But now, what happens if we have to pay the VAT on an accrual basis, meaning that we have to pay the VAT on the full contract amount that we sold in 2020? And as you can see here, whereas before it was 400,000 in VAT that we had to pay, now it's 600,000 in VAT that we have to pay. So it's significantly higher, and this is mainly the case if the business is growing rapidly. And that's why, if possible, from a tax perspective, it often makes sense to use cash accounting. And that's why we think it's important to include this, to include the effect of that, so that businesses can actually indicate whether their tax has to be paid on an accrual or a cash basis. Yeah, so these were some of the key functionalities. And as mentioned, they are also described in the user guide that will be published together with the model.